On October 14th, China's State Taxation Administration published the 2023 individual income tax data, stating that over 70% of people in China are currently exempt from paying individual income tax. It also claimed that individuals earning less than 100,000 yuan a year are generally not subject to this tax, and that more than 50% of individual income tax is contributed by those earning over 1 million yuan annually. Has China truly realized common prosperity? Hi, I'm Dongxiang. Welcome to Dig Into China, where we take a deeper look at China to reveal insights you can rarely find anywhere else. Today, I will interpret these individual income tax data for you. The late former Premier Li Keqiang once remarked that the 600 million people in China earn less than 1,000 yuan a month, equivalent to about $140, and that 900 million people earn less than 2,000 yuan a month, or roughly $280. So has the situation for low-income groups in China improved over the past few years? First, let's estimate how many people in China are currently paying individual income tax. In 2018, the Chinese government increased the individual income tax threshold from a monthly income of 3,500 yuan to 5,000 yuan. Subsequently, the State Taxation Administration reported that when the threshold was set at 3,500 yuan, there were 157 million individual income taxpayers in China. However, after raising the threshold to 5,000 yuan, the number of taxpayers fell to just 65 million by 2022. Now, the State Taxation Administration claims that around 70% of individuals in China are exempt from paying individual income tax. It's important to highlight that this 70% refers to the working population recorded in the income tax system, not the total employed population in the country. As previously mentioned, there are 65 million individuals with taxable income above 5,000 yuan per month. This suggests that around 220 million people have recorded income in the tax system. However, the working population aged 16 to 64 in China exceeded 900 million, with total employment also exceeding 700 million, including 177 million farmers. This indicates that out of 700 million workers, only 220 million qualify for the tax system, leaving 500 million who cannot be found in individual income tax records. Why is this the case? These individuals are often farmers, temporary workers, or they receive their wages in cash, meaning they do not appear on company payroll lists. In reality, these people constitute the majority of China's labor force. So how many individuals do you think earn more than 5,000 yuan a month? I can confidently say that if a Chinese person is receiving tens of thousands of yuan in cash each month without paying taxes, the Communist Party has the capability to track you down for tax payments. Let's not forget how strict local governments are with tax enforcement nowadays. Therefore, we can deduce that the 500 million people who aren't even included in the individual income tax system likely earn less than 5,000 yuan a month. Next, let's examine the approximately 220 million individuals in the individual income tax system and the industries they belong to. First, we consider those in the public sector and the state-owned enterprises who are certainly registered and can be found in the tax system, totaling around 79 million individuals. Then we have employees of publicly listed companies whose numbers are disclosed in their financial reports, amounting to about 30 million. Together, these two groups make up roughly half of the individuals in the individual income tax system. The other half primarily comes from larger private enterprises or those that operate in compliance with regulations. These organizations represent some of the best employment opportunities in China. However, in these prime employment sectors, only about 30% of individuals qualify to pay individual income tax. This raises the question, are they unable to pay taxes because their incomes are low, or do China's tax deduction policies enable them to enjoy high incomes without actually paying income tax? We can look at the numbers for insight. The tax authorities indicate that over 60% of those eligible to pay income taxes are in the lowest tax bracket, which has a rate of just 3%. Now let's examine the income range that corresponding to the 3% tax rate. This rate applies to individuals with a taxable annual income between 60,000 and 96,000 yuan. Through our calculations, we found that around 39 million people in China fall within this taxable income range. Up to this point, we know that there are 220 million individuals in China's individual income tax system, with 65 million eligible to pay taxes. Among these, about 39 million have taxable income below 100,000 yuan, while roughly 26 million earn above that amount. Furthermore, the tax authorities report that high-income earners with annual income exceeding 1 million yuan make up only 1% of taxpayers, translating to approximately 650,000 individuals in China who earn over 1 million yuan a year. As a Chinese citizen, if you qualify to pay individual income tax, it indicates that you are among the top 5% of successful individuals in the country. What we discussed earlier refers to taxable income, which is your annual income after deducting allowable tax deductions to determine the final taxable amount. This does not accurately represent the actual income situation, so we need to estimate what people's real income levels are. Under China's current tax deduction policy, there are 7 special additional deductions available, including benefits for those with children, elderly dependents, home loans, and significant medical expenses, all of which can lead to tax savings. So how much do these deductions save taxpayers in China? According to the tax authorities, about 67 million people benefited from these policies in 2023, with the primary tax reductions coming from deductions for child education and elderly support. For child education, parents can deduct a fixed amount of 2,000 yuan per month for each child, allowing each parent to claim 1,000 yuan. For elderly support, the families with a dependent over 60 years old can have the only child deduct 3,000 yuan per month, while siblings would share this deduction. Additionally, those with home loans can deduct 1,000 yuan each month. Let's break down the deductions and the taxable income for each parent in this middle-class family scenario. Each parent earns an annual salary of 100,000 yuan. The child care deduction is shared, so each parent can claim 12,000 yuan per year. Similarly, the home loan deduction is split, giving each parent 6,000 yuan annually. Since both parents are only children, each is eligible for the full elderly support deduction of 36,000 yuan per year. Adding these up, each parent receives a total deduction of 54,000 yuan, leaving their taxable income at 100,000 yuan minus the 54,000 yuan deduction, resulting in 46,000 yuan of taxable income per parent. There is a common misconception that those who don't pay income tax must be earning less than 5,000 yuan a month. In reality, some individuals might earn over 5,000 yuan, but after applying deductions, their taxable income drops below the threshold. As a result, we can't assume that only 65 million people in China make more than 5,000 yuan a month. However, since the tax authorities haven't provided more detailed data, we can only estimate how many people actually earn above this amount. This estimate falls within a defined range. At most, it can exceed the 220 million people in the tax system, and at a minimum, it won't be lower than 65 million who currently pay income tax. So, where within this range might be true figures lie? There is a clue from the Tax Bureau, which reported that 67 million people benefited from tax deductions policies last year. If someone's monthly income is below 5,000 yuan, they wouldn't need these deductions. The number of workers in China without a mortgage, no need to rent, no children, and no elderly to care for is likely minimum. Thus, 67 million seems like a solid estimate. This suggests that around 2 million people, thanks to tax deductions, went from being eligible to pay income tax to being exempt. In China, anyone earning less than 100,000 yuan annually doesn't have to pay income tax. At first glance, This might seem like a generous policy, especially since 100,000 yuan is considered a pretty solid income. In contrast, in the US, if you are making $100,000 a year, you are doing well if you can keep $70,000 after taxes. However, this is merely a facade. The Chinese government demonstrates its cleverness here. While individual income tax may be lower, it compensates by collecting significant amounts through other means, often without people even realizing they are being taxed. One notable example is Social Security contributions. When we compare income tax with Social Security payments, the disparities become quite striking. While the Communist Party provides annual tax incentives, the Social Security contribution base rises sharply each year in every city, often at an astonishing rate. For example, Shanghai has recently announced that the minimum Social Security base will be increased to 7,384 yuan. This means that even if your monthly salary is only 5,000 yuan, both you and the employer will still have to contribute based on the 7,384 yuan standard. 6 years ago, the Social Security base in Shanghai was just 4,279 yuan, reflecting a 70% increase over that period, well above the rate of China's GDP growth. This surge is entirely unreasonable and seems designed to extract more from both businesses and employees. As the Social Security base rises, the contribution amounts for both your individual account and the pooled account that your employer contributes to will also increase. The issue is this: while the economy struggles and wages stagnate, the government provides some relief through individual income tax cuts, but at the same time raises the Social Security contribution base every year, increasing the financial burden on companies and individuals. The reason is simple: it's to keep people unaware. People can clearly see how much income tax they pay, so the Communist Party lowers it slightly to give the impression of reducing their burden. However, many don't view Social Security contributions as a tax, but as a welfare benefit. This makes it easier for the party to quietly increase taxes without facing public backlash. Take a look at the figures. Last year, China's government collected 7.97 trillion yuan from Social Security contributions compared to just 1.47 trillion yuan from income tax. The gap is striking. So which method of raising revenue is easier? If after all this, some people still think Social Security is a benefit rather than a form of tax, there's really nothing more to add. Social Security isn't just a tax on individuals, it's also an added burden on businesses. Every year, the Communist Party raises the Social Security base, which drives up labor costs for companies. With the private sector already struggling, how can they justify making it harder for businesses? The recent situation in Jiangsu caused an uproar. In October, the province increased the Social Security base and required companies and workers to retroactively pay the difference for the past 9 months. This blatant money grab is alarming, especially from a leading coastal economic powerhouse like Jiangsu. If even Jiangsu degraded to this point, expecting China's economy to recover is nothing short of laughable. To get a true picture of how much tax Chinese citizens pay, we must factor in their monthly Social Security contributions. Take, for example, a person in Shanghai with a monthly salary of 5,000 yuan. They would pay 590 yuan for pension insurance, 147 yuan for medical insurance, and 37 yuan for unemployment insurance, which leaves them with just 4,226 yuan in take-home pay. This means they are paying over 15% of their salary in Social Security. Does that seem like a high tax rate? The real issue isn't the individual income tax, it's the hidden burden of Social Security that the Communist Party uses to silently extract more from both people and businesses. To summarize, data from the individual income tax system indicates that around 220 million people are included in this system. Of this group, roughly half are employed in the public sector, state-owned enterprises, or publicly listed companies. This suggests that at least 1.2 1.2 billion people in China earn a monthly income of less than 5,000 yuan. Within the 220 million individuals in the tax system, only about 67 million have monthly earnings exceeding 5,000 yuan, and only around 650,000 earn an annual salary of over 1 million yuan. In summary, China's individual income tax is relatively low as the government primarily focuses on social security contributions for revenue. Over the past few years, the annual increase in social security contribution basis has consistently surpassed the GDP growth. This is particularly concerning given that the people's incomes are not increasing, yet the mandatory social security payments continue to rise, which appears quite unreasonable. Therefore, the only conclusion is that the Chinese government is actively collecting social security taxes. In 2023, the revenue from social security increased by 11.4% compared to the previous year. A simple adjustment to the social security contribution base allows the government to gain over 800 billion yuan in additional revenue annually, while the total income from individual income tax barely surpassed 1.4 trillion yuan for the entire year. This disparity clearly illustrates the substantial role that the social security contributions play compared to individual income tax. And I hope everyone can understand this important distinction. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.